The only glance at the quotes this morning, the screen looks pretty friendly. Corn is nudging higher, beans are firm, and even wheat has a little green on it. But just like we saw last week, quiet grains can be the most dangerous when they lull everyone into thinking risk is shrinking. Underneath these small moves, cattle are under pressure, crude has slipped, and fresh headlines since Thursday are reshuffling where the squeeze could show up. The question for today isn't are prices good or bad? It's whether these calm, slightly higher markets are setting up an opportunity or a spring trap for operations that relax too soon. Good morning. This is Boots and Bushels, your daily look at the markets that feed America. We're mapping out Tuesday's risk picture using where futures were trading near late in Monday's session as our guide. As always, this is about awareness, not advice. We're here to point out the pressure points so you can make decisions with your own numbers in mind. Today's map focuses on three big themes: grains quietly grinding higher, cattle taking it on the chin, and crude easing just enough to raise questions about fuel cost and demand. Let's start with the grain side of the ledger. Corn futures were trading near 440 and a half on the nearby contract late in Monday's session, up around a dime from recent levels. That's not a runaway rally, but it does suggest that buyers are willing to defend this area and maybe lean a little harder into spring risk. The pressure point here is whether this strength is coming from real demand, exports, feed, and ethanol, or just short covering the position shuffling ahead in the next round of reports. What traders are watching is if basis and export sales firm up to confirm this move. If they don't, the board can just as easily slip back and leave producers chasing a pop that didn't have much underneath it. Soybean futures are trading near 11.50 and a quarter, about 3 cents higher into the late trade. That small bump fits a market that's trying to respect both solid crush demand and big global supply ideas at the same time. The risk here is that any fresh confirmation of comfortable South American supplies or smooth export logistics can cap rallies quickly and turn these tiny gains into selling opportunities for the funds. The second layer of concern for producers is timing. If weather scares or logistical hiccups do spark a stronger push higher, the window could be short, and waiting for just a little more can turn into watching the bid fade back into the range. Chicago wheat was trading near 440 and a half as well, with a modest uptick on the day. Wheat continues to feel like a headline market. It doesn't need a lot of new information to move, but it also struggles to hold rallies without something concrete on the supply or export side. The pressure point is whether global buyers see enough value in U.S. origin at these levels to step in aggressively, or if they keep shopping in other regions and leave U.S. wheat dependent on speculative money. What traders are watching is a mix of export inspections, tender results, and any fresh talk about crop conditions and competing suppliers, because any surprise there can flip wheat from sleepy to suddenly active in a hurry. Live cattle futures were trading near 239 and a quarter, down sharply, nearly $3 lower late in the session. That kind of move signals real concern about how easily beef values can hold up against consumer pushback and rising costs across the chain. The risk here is margin pressures on both sides. If packers feel squeezed, they lean on cash cattle bids. If feed costs don't ease, country break-evens get even tighter. What traders are watching now is whether the break draws out stronger cash trade later in the week, or if it confirms that leverage is shifting back toward the plans, which would keep a lid on futures for a while. Feeder cattle futures were trading near 358.10, almost $3 lower on the day. That drop reflects uncomfortable math of pairing softer fat cattle with still stout input cost, especially feed and fuel. The pressure point is the cost of gain. When feeders slide while corn nudges higher, the spreadsheet gets harder to make work without a really confident view of future fat prices. The consequence for producers is that decisions about buying or holding back replacement cattle get more complicated because the board is signaling caution, even as long-term protein demand still looks steady. Lean hog futures were trading near 93.75, up slightly into the late trade. That firmer tone suggests hogs are trying to carve out their own path, supported by product demand and export interest even as other proteins wobble. The risk here is day-to-day volatility tied to wholesale pork values and any surprises on the export side. The risk here is day-to-day volatility tied to wholesale pork values and any surprises on the export side. This market can reprice quickly if product moves soften or shipping slows. What traders are watching is whether packer margins stay comfortable enough to keep kill schedule steady without pressing cash hog bids too hard, because that balance will shape farrowing and finishing plans through spring. Crude oil futures were trading near 66.30 late in the Monday session. off a bit on the day. That pullback takes a little immediate heat off of fuel cost, but doesn't erase the bigger story. Energy markets remain sensitive to global supply, shipping routes, and broader economic worries. The pressure point for producers is whether this softness is a pause in an uptrend or the start of a more comfortable price zone heading into heavy fieldwork. What traders and fuel buyers are watching is how quickly any new supply headlines or macro news snaps crude back higher. If the market treats dips as buying opportunities, fuel invoices may stay on the uncomfortable side of the ledger. Weather across key U.S. production regions has been fairly typical for late February, but typical still carries risk. Soil moisture, freeze-thaw cycles, and short-term temperature swings are all setting the stage for how quickly fields will be ready once planting windows open. The consequence of even a modest shift, a wetter than expected stretch, or a colder lingering pattern, is that markets like corn, beans, and feeders can react faster and the countryside can adjust, especially if traders see any threat to planting pace or pasture conditions. What markets are watching is the broader trend. If forecasts begin to lean clearly wetter, drier, or colder into March, that becomes the next excuse for funds to defend, support, or test resistance in the grain and cattle pits. Now for ag news. One of the most important stories has been fresh updates on global shipping routes and export flows, including ongoing concerns about disruptions or delays in key corridors. When vessels are rerouted or insurance and freight costs climb, it can quietly change which origins are competitive for corn, beans, wheat, and meat. The pressure point is the U.S. exporters are constantly being compared on delivered price, and any shipping wrinkle can either hurt or help that math. What to watch next is how export tenders and weekly shipment data respond. If U.S. volumes pick up on the back of someone else's logistics headaches, that can support futures even without a major headline. Policy and regulatory developments, another key thread since late Thursday, has been continued movement on farm-related policy and regulation, from conservation and environmental rules to program details that influence long-term planning. The specifics vary by program, but the common theme is paperwork, compliance, and potential shifts in how certain practices are treated. The risk here is operational, not political. New requirements can add time, cost, or both. Even when they don't make the front page, producers should watch for clear, plain language summaries from trusted ag sources that explain what has actually changed so you can separate real obligations from rumor. Input and equipment cost signals, recent updates from input suppliers and equipment makers continue to point towards steady to firm pricing heading into spring. From fertilizers and chemicals to parts of machinery, few signs point to a broad cost break. The consequence is a potential margin squeeze if futures don't widen the gap between revenue and expenses. What markets and lenders are watching is how aggressively producers lock in inputs and whether any pushback shows up in older books. A slowdown there can ripple through local economies and eventually touch land values and rental negotiations. Global crop condition and production estimates. Since late Thursday, new crop condition snapshots and production estimates from key global regions have kept the conversation going around just how comfortable supplies really are. Some areas look solid, others carry nagging weather concerns, and together they shape whether traders feel safe keeping grains in a narrow range. The pressure point is that any surprise adjustment, even a modest downgrade in a major exporter, can be enough to jolt corn, beans, or wheat out of their slow grind. What to watch next is the combination of satellite-based updates, local reports, and official agency projections as they roll out over the next couple of weeks. In our last story, technology and efficiency announcements. The past few days have brought more announcements around farm technology, from data tools to automation to new genetics meant to stretch performance. These tools promise better efficiency and a more precise use of inputs, but they come with real upfront costs and learning curves. The consequence is a widening gap between operations that can adopt and integrate new tools and those that feel priced out of or overwhelmed. What markets are watching is how quickly adoption spreads, because over time that can quietly shift yield potential, cost structures, and even local basis. As we head into Tuesday's trade, the surface picture is calm. Grains are trading near slightly higher levels. Hogs have a bit of firmness, and crude has eased off recent highs. But under that calm, cattle are under pressure. Input and equipment costs are holding up, and global logistics and policy stories are still very much in play. For producers, the key is to treat these quiet sessions as a chance to tighten up your awareness rather than relax. Because the squeeze usually shows up first on the balance sheet, not on the quote screen. Thanks for starting your day with Boots and Bushels. I'll be back here again tomorrow.